Hey, I just bought a brand new car, could have paid all cash, yet I chose to get a loan. I've now got massive car debt by choice. Why? Because it's the financially smart thing to do. I've now got 5 years of $975 a month payments to look forward to. I'm already underwater on the new car purchase, meaning as soon as I drove it off the lot, it instantly depreciated and I now owe more on the car than what it's even worth. I'm not using the car for business in any way. It is pure fun. Though that sounds irresponsible, let me tell you why this is actually a savvy money move and what it has to do with real estate. Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, best-selling author, and longtime real estate investor. Though I could have paid all cash for it, I chose to put the minimum amount down and I got a loan for about 95% of the cost of the car. Why would I do this? Car debt is surely not as good as real estate debt. With car debt, I have to repay my own loan. I cannot outsource these car debt payments to anyone, like how I can do that with tenants on a rental property. I outsource those mortgage debt payments to the tenant's rent that they pay me. With the real estate, I can't do that here. I've got to pay all $975 each month by myself. Unlike real estate, a car is a depreciating asset too. Unlike mortgage interest, this car loan interest is not tax deductible at all. Now that might sound like 3 strikes against a car loan. I've got to make the payment myself. It's declining in value, especially as a new car, it depreciates fast, and I won't have any tax breaks. That might sound like it's got to be bad debt. Leading GRE, I'm a staunch advocate for good debt, so why did I embrace a car loan to the maximum leveraged amount? Am I renting it to others on Turo or putting it to work with some other business use? No, nothing like that. Yet I am turning this new car loan into good debt, and this sounds counterintuitive, totally iconoclastic. All right, the definition of good debt is debt that makes money for you. Car loan debt is secured, meaning there is underlying collateral, the car itself. And by the way, credit card debt is an example of unsecured debt. Well, the fact that car loan debt is secured debt helps the lender, the bank, not me. Their collateral has value. The big reason for doing this, though, is the financing through the dealership. BMW is a 3.99% interest rate for 5 years. My credit's perfect, so I got a good rate there. Therefore, the first reason I did this is that this car loan is a simple arbitrage play. Arbitrage is that fancy sounding word. It just means that I plan to profit from a spread. I'm borrowing at a lower rate with the intent to invest at a higher rate. Even if my car loan rate were double, 8%, I will probably still get this car loan, but it's 3.99%. Now, how do I have the confidence that I'm going to beat that on an annual basis over the next 5 years? Well, first, future inflation expectations are elevated, like I've discussed elsewhere on the channel here. Government reported inflation measures like the CPI, PPI, and the core PCE understate the real inflation rate. If the true rate, the real diminished purchasing power of your dollar over the next 5 years is 4% annually, all right, well, that right there is already a break even for me. You can make the case that true inflation is over 4%. Well, in that case, I would be profiting already. For example, just say that true inflation is 5%. All right, well then every $975 monthly payment that I hand over to the bank for the car loan, those dollars get debased on the bank faster, 5%, than their interest charges can accrue on me. 4%. And my $975 payment stays fixed. Inflation cannot touch it. It won't increase, even though it does get easier to pay back as over 5 years, wages go higher, salaries go higher, and rents go higher. This is why inflation transfers wealth from lenders to borrowers, and inflation transfers wealth from savers to debtors. But I'm going to do a lot better than this. As a real estate investor, I know that instead of sinking this money into the car, now I've got enough of a down payment for a single family home or almost enough for a low-cost duplex. And being cognizant that real estate pays 5 ways, I expect a minimum of a 20 to 25% total rate of return with low risk. All right, so how is this car actually making money for me? Say I get a 23% total return from income property and keep paying 4% on the loan. That is 19% arbitrage. That is almost 5x. And again, the definition of good debt is debt that is used to increase your wealth. Now, if you're a new viewer, that part about a 20 to 25% returns sounds far-fetched. I know, that's okay. I'll get back to that. You just don't yet know how to calculate your return on investment from an income property, and that's okay. I'm being cognizant of what's called opportunity cost. Opportunity cost means that you're missing out on a greater benefit when you choose one option over another. But there are so many other reasons besides profiting from the arbitrage that this car loan is good debt. A different angle here that you can think about this through is, though I could pay all cash, why would I sink that much into a car? Why would I have that much money tied up in a depreciating asset? Look, your car's value and its depreciation rate has absolutely nothing to do with whether you got a loan on it or not. Real estate works the same way. Real estate goes up or down in value regardless of how much equity you have in your property. This way, I got the bank's money tied up in the car, not mine. I've got more reasons on why this is the savvy approach, though most people don't think about it this way. Hey, go ahead and put a like on the video if at least I'm giving you some thought-provoking material here. Really appreciate the like. Most people do not think this way, they do not act this way, but you've got to diverge from the herd if you're ever going to build real wealth. I mean, if you ever want to be in the top 1%, you are going to be misunderstood. This loan approach also keeps me more liquid. Look, keep your money. Don't give it to a bank and hand it all over right away. Make them wait 5 years to get it all. You earned your money. And to earn money, you expended your truly finite resource of your time on this earth to make that money. You took time away from your family and friends to do that. You're never going to get that time back. If you're trading your time for dollars and selling your time for money, then why would you just go give it away so quickly and easily? Think about it that way first before you consider just handing over a lump sum of cash. Stay liquid. And there's another layer here. Be mindful, by paying all cash, you wouldn't improve your net worth at all. Net worth is the total sum of all of your assets minus the total sum of all of your debts. Well, paying all cash reduces both your asset column and your debt column by the same amount. So it hurts your liquidity and does nothing to improve your net worth. I mean, now if you've got an emergency, those funds are gone. They're inside the car, they're held by the bank, they're illiquid. You might not be able to extract them back out. A car makes a terrible bank account. Look, when you have loans, you have another type of leverage. It's not the mathematical type that I sometimes discuss here. For example, have you ever owed a friend money and then say something untoward happens to you? Who's motivated to talk to who? Who's motivated to work with who? If you, the borrower, lose your job or you have a medical disaster, the one that's owed the money, the lender, they're always motivated to keep communication lines open with you because you're the debtor. You're the one that owes someone money. Now you're the one that's in control. Keep your debt on, keep your own money, stay liquid, stay in control, and even have your money off earning more for you. You could pay off the loan whenever you want as well over the 5 years. Again, with the loan, you are in control of this transaction. The lender is not. So getting the max car loan allows me to avoid paying the opportunity cost of having the funds all tied up in a depreciating asset. That is how a real estate investor buys a car. Now, you're a smart investor. We have a really wise, educated audience comprised of people just like you. Sometimes when people are presented with new information, they just want to refute it merely because it's new and one has believed the same old thing for so long. The good news is that you don't have to believe everything that you think. I mean, there was a time in my life when I thought that all debt was bad, and especially all car debt had to be bad. But now let's look at the flip side. What would be some reasons that someone should pay all cash for a car? Because there are a few, and a lot of them revolve around if you're just financially irresponsible. If instead you did this because it was to stay liquid so that you could maintain your life as a profligate and reprobate gambling degenerate and then lose all that money on sports gambling on the DraftKings and FanDuel apps. But because you're watching this, that probably isn't you. Another reason to pay all cash rather than getting the loan like I did is if there is over leverage risk. This means that you don't have the means to service the $975 monthly debt payment for yourself, or if there's a risk of that in the future. See, the chunk that I'm investing in real estate instead of a depreciating car, that real estate will produce income, but it actually won't produce $975 in monthly cash flow to fully offset the car payment. It'll produce a few $100s, but my arbitrage is being created with the summation of all of those other real estate profit centers. I've got the whole shebang now, all 5 ways real estate pays: the leverage appreciation, cash flow, return on amortization, tax benefits, and the inflation profiting all coming at you. My liquidity comes from elsewhere. A third reason to pay all cash is if the new loan would dent your credit score too much, or if you're a real estate investor, you would effectively be forced to pay all cash because the monthly car payment would dent your mortgage loan debt to income ratio. It would hike up your DTI so much that, say, you couldn't qualify for future income property loans, hampering your credit worthiness. So right there are 3 reasons that a real estate investor would want to pay all cash for a car if they could. But don't lose the bigger point. They are not my situations, and they might not be your situations either. Consider getting the maximum loan for your next car. It's actually a rational approach to consider the loan first, because again, this is your money. You earned it, so consider keeping control of it first. Approach it with that strategy before giving it away with the all-cash approach, the alternative. I'm getting the biggest car loan that I can and making the minimum monthly payments all 60 months, 5 years. I did the same thing with my last car, and I sure am glad that I did. It's an easy choice for me. In just one word, it is for the arbitrage. One word. Most experienced financiers and real estate investors, they just really haven't been exposed to ideas like this that I just shared with you. At the least, I'm confident that I just gave you something to mentally chew on here. You've got family or friends that think car debt is bad, show them this video. I considered not getting a car at all and just using Uber and ride-sharing services forever. You never have to pay for parking that way either, but sometimes I like to drive out of the city to remote places, so that just really wouldn't work. I travel a good bit, and I considered not owning any car that's tethered to one place, but it came down to freedom. I enjoy my freedom and autonomy to hop in my own car and just go drive it on a whim. Consider not owning a car. If it works for you, think about what you can do with that extra garage space too. When it comes to understanding how anything less than a 20 to 25% return from income property is actually disappointing, like I mentioned earlier, you are really in luck. It is now out there. It has begun. I just released the most important video series I've ever made in more than 10 years as a channel here. This is course level instruction, and it is free right here on the channel. The course is called Real Estate Pays 5 Ways. Yeah, you know, these returns could sound a little far-fetched or like it must entail some high-flying risk. No, even 25 to 30% is common just from buy and hold income property, and your return is also less volatile than stocks. Even with conservative estimates, even with an expensive, surprising electrical or plumbing problem factored in. You don't have to be a landlord or a house flipper. Those things are jobs. Most people just don't know how to figure out their return. Real estate has made more ordinary people wealthy than anything else. This is why you can retire early. You're finally going to see how, and I'll add up your total return in a clear way in this series of 5 videos. Your example property earns a return on investment from each video, and then we'll total up all the 5 ways at the end, and you will get a real life percentage. It's course level instruction updated for today's times. You've never seen anything like it because I coined the concept real estate pays 5 ways. Watch the first of the 5 videos in the course right here.